Credit Decoded: How your consumer, business, and bank credit scores really work. You have a consumer credit score. Nearly all adults have one. You get one when you have credit, and it's been reporting for 6 months at least. And you generally get credit when you apply for credit, borrow money from a bank, or you buy real estate. A consumer credit score is a mathematical model used to depict a consumer's risk of going 90 days late on an account within the next 24 months. Personal credit scores take time to build as they are based on 5 factors. Number 1, payment history, which is generally 35% of the total score. Number 2, utilization for individual accounts and all over utilization, 30% of the total score. Number 3, length of credit history, average age of all your accounts, but also the age of the oldest account that you have, 15% of the total score. Number 4, accumulation of new credit, 10% of the total score. Number 5, credit mix, 10% of the total score. There are 3 big credit reporting agencies for personal credit. TransUnion, they report on consumer credit only. Experian, they report on both consumer and business credit. Equifax, they report on both consumer and business credit. Smaller credit reporting agencies aren't checked as often. The big 3 matter a lot more. Your credit scoring numbers. Personal FICO credit scores range from 350 to 850. Vantage consumer credit scores range from 501 to 990. It's an earlier model. And Vantage 3.0 consumer credit scores range from 300 to 850. TransUnion uses the Vantage Score 3.0 model. Their scores run from 300 to 850. A Grade A credit score is 781 to 850, and a Grade F credit score is 300 to 600. Your TransUnion credit score broken down. Number 1, your payment history, 40%, and is the most important factor. Number 2, credit utilization, 20%. Number 3, length of your credit history, 21%. Number 4, total amount of recently reported balances, 11%. And number 5, new credit accounts, 5%. A business credit score is a mathematical model used to depict a business's risk of going 90 days late on an account within the next 12 months. There are 3 big credit reporting agencies for business credit. Dun & Bradstreet is just for business. Experian reports on both personal and business. Equifax reports on both personal and business. Smaller credit reporting agencies aren't checked as often, as the big 3 matter a lot more. Your business credit score isn't automatic. Unlike for consumer credit scoring, you have to apply. You apply for a DUNS number from Dun & Bradstreet. They send you a number. You get an EIN from the IRS. D&B starts tracking your business's financial activity, and then they give you a Paydex score. Business credit scores are scores that are in the business's name. With business credit, a business builds its own credit profile and credit score. With an established credit profile and score, the business will then qualify for greater credit. This measures the business's ability to pay and not the owner's. Most major business credit scores range from 0 to 100. There can be different scores on reports. Consumer reports show 1 score per bureau, but business reports typically show multiple scores per business. There's a primary score like Paydex or IntelliScore, and there are other scores like D&B's Supplier Evaluation Risk Rating, SER, D&B's Supplier Stability Indicator, SSI, Equifax's Small Business Credit Risk Score for suppliers, and Equifax's Business Failure Score. Dun & Bradstreet processes data about your company, checking for accuracy, completeness, timeliness, and global consistency. Dun & Bradstreet's reports show payment records, upper credit limit, net worth, current assets, and more. Dun & Bradstreet looks at bankruptcies, liens, lawsuits against your company, your credit card payments, your bill payments, and more. D&B Paydex scores range from 0 to 100. and 100 is the best score a business can get. A score of 80 or higher is considered good or healthy credit. A business can get a good business Paydex credit score by ensuring payments are made promptly to suppliers and vendors. Good Paydex scores are important. A business needs a Paydex score of 80 to get the most favorable financing. This score says the business pays all its bills on time. To get a Paydex score, a business needs at least 5 trade accounts reporting to their file. It can take up to 90 days for those trades to report and a score to be established. The business credit score itself is calculated by using as many as 875 payments. Paydex scores are a weighted average. Paydex gives more weight to trade accounts that report higher amounts of credit extended. It gives less weight to trade accounts that report lower dollar amounts of credit. To keep Paydex scores up, if you can only pay one bill, pay the biggest one first. D&B SER, Supplier Evaluation Risk Rating. It predicts likelihood a company will file for bankruptcy and cease operations within the next 12 months. Scores range from 1 to 9. 1 is the lowest risk, and 9 is the highest. D&B SSI, Supplier Stability Indicator. This model predicts likelihood that a supplier will encounter a large and significant financial or operational stress over the next 90 days. Score ranges from 0 to 10. 0 is the lowest risk, and 10 is the highest. Experian Commercial works from a large database. They apply their own analytics software. Their reports include public records, scoring, trade information, financial history, court judgments, and UCC filings. Experian Commercial uses IntelliScore, their proprietary scoring system. The scores range 0 to 100. A percentile score reflects which businesses do better or worse than the other under scrutiny. The new IntelliScore Plus has over 800 aggregates or factors affecting it. Experian's methodology is to look at data segments like firmographics, public records, collections, and trade information. They then put each business in one of 3 different models. The commercial model is for small, medium, and large businesses. The blended owner model has the commercial data linked with owner's information. IntelliScore Plus represents their percentile score. IntelliScore Plus is based on payment history, but many other factors tie into percentages of overall score. Historical behavior, payment history, equals 5 to 10% of the total score. Current payment status, trade balances, and percent of accounts delinquent equals 50 to 60% of the score makeup. Credit utilization equals 10 to 15% of the total score. The company profile, age of business, industry risk, and size of business assessed by number of employees equals 5 to 10% of the total score. And 10 to 15% of the total score is based on derogatory items, that is, collections, liens, judgments, and bankruptcies. How long does data stay on Experian? Bankruptcies, 9 years plus 9 months. Judgments, 6 years plus 9 months. Tax liens, 6 years plus 9 months. Collections, 6 years plus 9 months. Uniform Commercial Code filings, 5 years. Bank, government, and leasing data, 36 months. Trade data, 36 months. Equifax collects utility account information, trade vendor data, public records such as bankruptcies, judgments, lawsuits, and liens, and information from the Small Business Financial Exchange. Equifax credit scores break down as follows. Credit risk score predicts likelihood of business incurring a 90-day severe delinquency or charge-off over the next 12 months. Business failure score predicts likelihood of business failure through either formal or informal bankruptcy the next 12 months. Payment Index provides dollar-weighted index of businesses' current and past payment performances based on all payment experiences in the Equifax commercial database. The Equifax Small Business Credit Risk Score predicts likelihood of business incurring greater than 90 days severe delinquency or charge-off on financial service accounts within a 12-month period. The score is built using financial services and trade payment data, providing a higher degree of predictability. The score range is from 101 to 992. It returns up to 4 reason codes: A 0 indicates a bankruptcy. The Equifax Business Failure Score predicts the likelihood of business failure through either formal or informal bankruptcy within a 12-month period. It is built using financial services and trade payment data, providing a higher degree of predictability. The score ranges from 1,000 to 1,880. It returns up to 4 reason codes. A 0 means bankruptcy. Then there's the FICO SBSS, Small Business Scoring Service. The SBA uses this. The scores reflect the likelihood of an applicant paying their bills timely. Scores range from 0 to 300. Higher scores mean lower risk, and the higher score you have, the better. Your personal and business credit history plus financial data go into the total score calculation. The FICO SBSS scoring range matters. For SBA loans, you won't be approved with a score under 140, but then typically set a cutoff as high as 160. Below that, you will probably be denied because of being too high a risk. And chances are good that the SBA lender won't even submit your application to SBA if your score doesn't meet the threshold. The FICO SBSS business scoring formula takes into account, among other things, personal credit information, business credit history, the age of the business and years in business, and financial details like cash flow and revenue. Scores range from 350 to 850. FICO SBSS data combos are flexible. Small business credit issuers can get different combinations of data to evaluate the risk of a business. It can be just Paydex, just Experian, etc. If there isn't enough data, SBSS uses a business owner's personal data. The FICO SBSS Credit Offer Index is designed to help credit issuers know how much to lend or the capacity of the applicant. It represents a benchmark against what businesses of similar profiles have requested in the past. It is made up of application data, known financial info, Consumer Credit Bureau data, and Business Bureau data. It returns a percentile ranking of the current request versus other similar small businesses, plus the amount of money requested from those businesses. This index can be used whether financial data was supplied as part of the application process or even if it wasn't. And it can be used by credit issuers to see if the amount being requested is in line with the industry experiences for that type of small business. What can lower a business credit score? Current collections, liens, judgments, bankruptcies, or other derogatory public records. Status, recency, frequency, and dollar amounts of applicable liens, judgments, or bankruptcies. An increased trend in slow payment of obligations. An increase in number of business credit inquiries or applications generated by the business or the owner. The number of trade experiences, balances outstanding, payment habits, credit utilization, and trends over time. And the years in business, line of business or standard industrial classification, SIC code, size of business, and other demographic data. Bank credit scores are different. Bank credit, also called a bank rating, is the total amount of borrowing capacity a business can get from the banking system. It is not the same as business credit, which is a much broader category of lenders such as suppliers, credit card issuers, or leasing companies. A business can get more business credit quickly, long as it has a minimum of one bank reference and an average daily account balance of at least $10,000 for the past 3 months. This yields a bank rating of low 5. Meaning an adjusted debt balance of $5,000 to $30,000. A lower rating, that is a high 4, or balance of $7,000 to $9,999, won't stop a business's application, but it will slow down the approval process. Here are the bank ratings and what they mean. A high 5, account balance of $70,000 to $99,999. A mid 5 equals an account balance of $40,000 to $69,999. Low 5 equals a balance of $10,000 to $39,999. A high 4 equals $7,000 to $9,999. Mid 4 is $4,000 to $69.99. And a low 4 is equal to $1,000 to $39.99. You can keep bank ratings up by doing whatever it takes to keep at least $10,000 in an account over a 90-day period. Money should be kept there just to ensure a bank rating is high enough to increase future financing approvals. Each cycle is based on the balance rating during the previous 3-month period. Before a business decides to apply for credit, it should keep a balance rating of low 5 for the last 3 months. More bank rating factors include number of non-sufficient funds, NSFs, positive cash flow, consistent deposits, age of account, the bank products the business uses, any savings account or investments a business has. The trick to keeping your scores up. Payment history is important to all of these scores except bank credit. Credit utilization is next most important. The length of credit history, or for businesses, time in business. Concentrating on these 3 areas will produce the most impact most quickly. Tricks to keeping a bank rating up. Keep money in the bank over a 90-day period. Retain a balance of $10,000 or better. Keep up a positive cash flow and keep the accounts balanced to avoid NSFs. Credit decoding isn't so complicated after all. A lot rides on you or your business's payment history, and your ability to pay your debts in full and on time has a huge impact. Don't use more than maybe 30% of all available business or consumer credit. Be patient and allow time to lengthen credit history and/or time in business. And keep money in the bank with a positive cash flow and avoid NSFs. Contact us today to learn more about Credit Decoded, how your consumer, business, and bank credit scores really work.